Hey everyone, welcome back to Corporate Decoder. Today AKTX just filed an 8K and I'm spotting a potential dilution event that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing reveals a new securities purchase agreement that could see the company selling more shares. And we need to understand the details and the potential impact on existing shareholders. Alright, let's dive into what Akari Therapeutics PLC has filed. This is a Form 8K, which is basically a report for significant events that shareholders should know about right away. The key date here is May 2026. This is when the company entered into a new agreement. What they've done is sign a securities purchase agreement. Think of this as a deal to sell more shares and other related securities to certain investors. This deal involves a private placement, meaning they are selling these shares directly to a select group of investors. Not the general public. They've brought in Paulson Investment Company as a placement agent. They are essentially helping to find these investors and manage the sale. So what exactly is being sold? The company plans to sell American Depository Shares, or ADSs. Each ADS represents 80,000 of their ordinary shares, but that is not all. Along with these ADSs, or in place of them, they are also selling pre-funded warrants and a host of other warrants. These other warrants are called Series H, Series I, and Series J warrants. Together with the ADSs or pre-funded warrants, these are being bundled into what they are calling units. So one unit will contain an ADS or a pre-funded warrant, and then warrants to buy more ADSs. The price for these units, if you are buying the ADSs, is $3.74 per unit. If you opt for the pre-funded warrant instead of an ADS, the price is slightly less, $3.739. This difference accounts for the exercise price of the pre-funded warrant, which is very small, just a penny. The company expects to raise about $5.5 million from this offering before paying fees and expenses. These fees and expenses are estimated to be around $125,000. And what will they do with this money? The plan is to use it for working capital, which is essentially the money needed to keep the day-to-day operations running, and for general corporate purposes. This is pretty standard language. Now, let's talk about the placement agent, Paulson. They are getting a fee. This fee is 2% of the total purchase price of the units sold. On top of that, the company is also issuing 117,647 ADSs directly to Paulson. This is a significant chunk representing about 8% of the total ADSs issued in this offering. This is often referred to as a placement agent fee in kind. Here is a crucial point. The issuance of these series warrants and the ADSs being given to the placement agent requires shareholder approval. This means the company's existing shareholders will have a say in whether this part of the deal goes through. If they don't approve it, the deal might look different. The series warrants themselves will have an exercise price of $3.74 per ADS, and they can be exercised once shareholder approval is obtained. The pre-funded warrants are exercisable immediately. Another important detail is that the company has agreed to file a registration statement with the Securities and Exchange Commission, or CC. This filing is to register the resale of the shares that will be purchased under this agreement, including the shares that could be bought by exercising the warrants. They have to do this within 30 days after the final closing of the deal. This is to make sure that these newly issued securities can be legally resolved in the future. This isn't a one-time cash infusion. The money from this offering will come in 3 parts or tranches. The expected closing dates are around May 27, 2026, the 15th of June, 2026, and the 15th of July, 2026. The company is relying on an exemption from registration under the Securities Act of 1933. This means they are not going through the full registration process with the CC for these sales. They're doing this because they believe the investors are sophisticated enough, specifically that they are accredited investors. Accredited investors are typically individuals or entities that meet certain income or net worth requirements and are therefore presumed to be able to understand and bear the risk of such investments. This section, item 3.02, essentially confirms and elaborates on the unregistered sales of equity securities that we just discussed under item 1.01. It reiterates that these securities were sold without a full registration process, relying on specific exemptions. And finally, item 9.01 lists the exhibits filed with this report. You'll find forms of the various warrants and the securities purchase agreement itself. These are the legal documents backing up everything we've discussed. Among the exhibits are the forms of the pre-funded warrant and the Series H, Series I, and Series J warrants. These documents will contain the precise terms and conditions for each of these warrants. Exhibit 10.1 is the big one, the form of securities purchase agreement. This is the actual contract that spells out all the details of the deal between Akari Therapeutics and the investors. The filing is signed by advisor Gaslight Waller, who is the president and chief executive officer. This shows this significant agreement has been officially approved by the company's top leadership. So, what's the big picture here? Akari Therapeutics is raising capital through a private placement. They are selling ADSs and warrants. The total amount is around $5.5 million. To be used for general business operations. Now, let's look at this from a shareholder's perspective. Anytime a company issues new securities, especially without a full registration, it can lead to dilution. This means that each existing share will represent a smaller percentage of ownership in the company. They are giving away ADSs as part of the placement agent fees, which is also dilutive. The fact that the warrants and some of the ADSs to the placement agent require shareholder approval is a critical watch point. If shareholders vote against it, it could scuttle a significant portion of the deal. We need to see how that vote plays out. Historically, companies that conduct these types of private placements and offer warrants can signal a need for immediate cash. While the price per ADS unit is $3.74, we need to consider the potential for these warrants to be exercised later, which could bring in more cash but also further dilute existing shareholders. Thinking about a comparable back in 2021. When Kodak did a reverse stock split, their stock eventually saw a significant drawdown. While this isn't a reverse split, it is a dilutionary capital raise, and similar to how some companies after significant dilution from offerings have seen pressure on their stock price. For example, investors who held a hypothetical $1,000 position might see its value decrease due to the increased number of shares, potentially by 10 to 20% over a short period if the market reacts negatively to the dilution. The risk here is that the company might be signaling a need for cash to sustain operations, and the dilution from this offering, especially with the shares going to the placement agent, could put pressure on the stock price. On the other hand, if the capital raised helps the company achieve its next milestones, it could be a net positive in the long run. The biggest concern for me is how the shareholders will vote on the warrants for the placement agent. If that approval doesn't happen, the economics of the deal change significantly. Alright, that is my take on Akari Therapeutics' latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.